Hello, everybody. My name is Ignacio Salazar. I am the CEO of Highfield Resources. Highfield is a ASX company. We have a project, the Muga Project in Spain, Potash project, Potash development. What you can see that in that first slide is the artistic impression of the plant that we are going to build next to our mine in Spain. We are about to start construction, and Highfield has a market cap of around 200 million Aussie dollars. If the company and the project, we are very close to the city of Pamplona that you see there in the map in the top left corner is famous for the bull run, and we own a few tenements going from Pamplona to the southeast in what is called the Ebro Basin. There are two historical mines in this area, and we have 40 people working in Highfield. Most of them are working in our office in the city of Pamplona. We are going to develop a first phase with 500,000 tons of muriate of potash, following by the second phase with another 500,000, adding a total of 1 million tons. Why Highfield Resources? I'd like to cover 5 key reasons in this presentation. The first one is the project itself, and it's a project with high margin and high profitability. Number 2 is this project is run by an experienced team supported by a strong board. Number 3, we are dealing with an attractive commodity, potash. Number 4, we have a strong financial position, and we are supported by good shareholders. And finally, timing, both in the potash cycle and let's say the situation in the project when we are about to finish with the permits and to start with construction. To start with the profitability of the project, there are 3 key reasons I would like to cover. The first one, you can see in the top left picture there, we have a mineralization that is quite shallow at Muga. We start at 350-meter depth, so we are planning to access that mineralization with 2 declines. Typically, potash projects are at depths of more than 1,000 meters, and typically they go through aquifers, something that we don't have. Both the depth and the aquifer in between make typically potash projects quite expensive, difficult to maintain, difficult to build. They need to use a shaft compared to our alternative that is working with declines. In addition, we will be developing a conventional mine based on room and pillar, so everything quite standard and a lot more efficient than typical potash projects. The second reason for this project to be special is the access to tier 1 infrastructure. We are in the middle of a network of motorways. The one that you see in that picture is in fact going to the mine from Pamplona. We are 200 kilometers, a bit more, to the port of Bilbao, Spain's largest port, deep water port, and also you can see as well close to electricity that is a substation close to the mine. So very good infrastructure. And the third reason, and probably last but not least, the most important, is the location of the project, sitting in an area with a very strong demand for fertilizers. It is an area very intensive in agriculture in the north of Spain and south of France, where there is not much supply. So if we are going to be supplying customers in this area in Europe, our competition comes from Belarus or Russia. Of course, they have to take the product for a longer distance. And we have also relatively good access to Brazil, which is a very important market in potash, 10 million tons of demand out of the 67, 68 million tons globally, where competition would be coming from the middle of Canada. So very good location for a bulk commodity like potash, important in terms of cost, where we have a clear competitive advantage. If we add that all together, the cash cost of the project are sitting at 82 euros per ton, very competitive. In addition to that, with the low transportation cost, we are going to get in this project higher netbacks at mine gate. And in addition to that, as you see in the chart, European prices, which is where most of our, at least the initial production will go to, are trading at a premium to global prices. So cost, transportation, and prices add up to a margin that, when compared to the industry, puts us in the first quartile or in a very good position, better than most projects globally. So a very, as I said at the beginning, very profitable project. In addition to the profitability, this project requires lower Capex, lower investment than other projects. I mean, the point, of course, about the declines versus the shaft that typically happens in many other areas. You can see Muga, in terms of Capex intensity, dollars per ton, we are covering both phases around $600 per ton, when most of the industry needs almost double that amount, 1,000 or more. Adding, of course, the low investment required for the project and the profitability give us the economics that you see there. NPV is close to 2 billion euros and an EBITDA in the order of 300 million euros at full capacity, at full production in this project. We, of course, are keen to close the gap between our current market cap of 200 million Aussie dollars versus 2 billion euros in terms of NPVs, economics of the project. And the first, or the main way to do it is to finalize with the permitting process. Is something that has been going on for a while in the company, but recently in June 2019, the company achieved a very important milestone with environmental approval already awarded, and followed by water and power permits. The mining during 2020, the mining concession documentation was submitted at the beginning of 2020, and we've covered. I mean, that work was split by the authorities in 5 blocks. We covered the first 4 and are about to finish with the 5th one. So we are very excited to see that the process is getting to an end. We haven't seen any red flags. On the contrary, of course, we are trying to move on, and the administration is sending us, the administrations are sending us the message that is simply a matter of time, and hopefully not a lot of time, to get to the finish line in terms of permitting. That will allow us to move into construction quickly afterwards, and is estimated to be 2 years of construction to get to production. That process, of course, needs the support of the market and a strong financial position that we are lucky to have at Highfield. The cash position at the end of last quarter, the financial statements that have been recently released, is a bit more than 20 million Australian dollars for the company. We have strong shareholders, very supportive, keen to see the company getting into construction and production, like EMR Capital with 30%, who owns 30% of Highfield, Australian Super 5%. And the company itself achieved a few years ago, went through an exercise and got pre-approval for debt credit facility of 185 million euros. So already that was achieved at a moment where the project was not as robust and as advanced as it is currently now. So we are very confident to be able to move forward and have the financial capacity to build the mine and get us to production. Recently, we are also lucky to see that the global potash prices are on the move. Hopefully, we are going to get the good size in the cycle. The crops prices have been increasing significantly. I mean, we are seeing prices that are highest in the last 5 years. Of course, potash price comes with a bit of lag following crops prices. The more money the farmers have, the more they can invest in fertilizers like potash. So we are seeing that, as you see at the bottom of that page, we are seeing that reaction. Europe is lagging a bit behind because just about the buying season will start now in the springtime in Europe. So we are very confident to see a very, very strong support to the potash price at a moment where the engineering is ready on our side and ready to issue to our construction partner. The project is ready to proceed from the point of view of sales and marketing, and as well we have appointed a financial advisor, so ready to move into the debt finance and equity finance strategy. So only waiting for the final stage in the permitting, and very much the company ready to go, hopefully in a very positive potash price environment. So just to summarize what I just explained, very strong market fundamentals for potash, hopefully getting at a very good moment now in terms of the potash price, low technical risk with a conventional mine, conventional processing, by the way, as well, and location making transportation cost low, potentially resulting in one of the highest margin potash mines globally, and also with a relatively low Capex requirement to start production. And by the way, I didn't mention that, but with a mine and a project with very strong ESG credentials. Is the first potash mine that is not going to leave any salt on the surface after production. We are going to backfill, or we are going to sell the salt. Highfield itself as a company is in a very strong financial position, a very strong support in the equity and debt markets, very experienced management team with track record and very strong board, very strong support in Spain, locally here, as well as in the markets. The timing I discussed as well, where we happen to be ready and about to start the construction we expect a very strong potash cycle, and well, in addition, some upside growth opportunities. Many thanks for your time and your interest in Highfield, and I appreciate your interest in the company. Thanks a lot.